Hey, welcome back. It's JWalter here. In today's video, I'm going to be sharing the latest news regarding mortgage delinquencies. A lot of you guys want to know, are people still paying their mortgages? Are foreclosures increasing? So with that said, I'm going to give you all the latest information. I'm also going to be sharing how each of the states and also the cities in the United States, how they fare, because there's some pretty big differences. So with that said, let's go ahead and dive right into the video. But first, if you guys are looking for a real estate agent referral, whether you're looking to buy or sell a house anywhere in the United States, then check out that link below, which is homeandmoney.com/Jason to get started today. So with that said, let's go ahead and begin today's video, and hope you guys are having an awesome day, by the way. This is according to a new report from CoreLogic. This is what's called their CoreLogic Loan Performance Insights Report, which basically looks at mortgage performance. And this analysis here, or this report, is through April 2022. And again, it was just released here a couple days ago at the time of this video here. This report is, by the way, is published monthly, and they cover national rates across the nation, of course, and also by state and also by metro. So I'm going to be sharing the states and cities that have the highest rates of delinquencies across the nation here. All right, with that said, let's go ahead and dive right in. So overall, the national mortgage delinquency rate, these are only for mortgages, is 2.9%. 1 year ago, it was 4.7%. So in 1 year, the rate decreased by 1.8 percentage points. According to the principal economist at CoreLogic, she had this to say: the U.S. foreclosure rate edged up in spring of 2022 after hitting a historical low at the end of 2021. Moratoria and forbearance that help keep homeowners out of foreclosure are expiring for many borrowers. I have some news regarding that because I have an update for you regarding mortgage loan forbearances, because I haven't talked about that in months on the channel, but I do have some new news regarding that. In the case, it says, but ongoing strong employment numbers and large amounts of equity should keep foreclosure rates low moving forward. So in regards to mortgage loan forbearances, here's the latest updates from the Consumer Financial Protection Bureau, or the CFPB. So if you go into their website, it says here that since March 2020, and by the way, that's when the CARES Act was passed in March 2020, millions of homeowners have received forbearance under the CARES Act, allowing them to temporarily pause or reduce their mortgage payments. So check this out, because a lot of people think that forbearances have ended. You don't have an opportunity to enter into forbearance, which you can pause your mortgage payment legally. But the reality is you can still enter into a forbearance plan. So on this website here, by the way, this is a government website here, it says you have the right to a COVID hardship forbearance if you experience a financial hardship, either directly or indirectly due to this pandemic, and you have a federally backed mortgage. However, though, it says for mortgages that are not federally backed, those would be mortgages that are not backed by HUD, FHA, VA, USDA, or Fannie Mae or Freddie Mac. So loans that are not federally backed, your loan servicer may offer similar forbearance options. If you're still struggling to make your mortgage payments, servicers are generally required to discuss payment relief options with you, whether or not your loan is federally backed or not. And here's the key question: when is the deadline for applying for a new forbearance program? If your loan is backed by HUD or FHA, USDA, or VA, you may request an initial COVID hardship forbearance as long as the COVID-19 national emergency is still in place, which by my knowledge, it's still in place. Additionally, if your loan is backed by Fannie Mae or Freddie Mac, there still is not a deadline to request an initial forbearance. And by the way, your initial forbearance plan is typically in the range of 3 to 6 months, but you can get up to 12 months of forbearance right now. I know I'm getting a little bit off track here, but I think it's worth mentioning, because if we do enter into a recession, if people start losing their jobs, then they should be aware that you can still get a forbearance plan where you basically can get permission from your loan servicer to stop paying your mortgages for a set period of time. And by the way, according to the latest report from the Mortgage Bankers Association, or the MBA, as of May 31st, and this was just published on June 21st, the latest stats for May, only 425,000 homeowners still remain in forbearance. And this is obviously down dramatically. This is according to Black Knight. Back in May 2020, we had approximately 4.7 million people in forbearance, and now we only have 425,000. So when the principal economist at CoreLogic says that a lot of these programs here are expiring for many borrowers, that's very true, because you can only get up to an 18-month forbearance plan if you applied earlier enough. And also, a lot of these people are exiting forbearance. However, if you still are experiencing a financial hardship and you have not entered into a forbearance plan yet, you still can apply for one. All right, so going back to support from CoreLogic here are the top 5 states. They have the highest overall delinquency rate for mortgages as of April 2022. So Louisiana led the pack at 5.4%. However, though, this is a 2.4 percentage point decrease compared to 1 year ago. This is followed by Mississippi in second place here, followed by New York, West Virginia, and Oklahoma. New York had a big improvement of 2.6 percentage points, whereas West Virginia only decreased by 0.9% from a year ago. So on a national level, as of April 2022, 2.9% of mortgages were delinquent, which basically means they were at least 30 days or more past due, and those actually include foreclosures as well. So right now it's 2.9%. 1 year ago, the overall delinquency rate was 4.7%. 30 to 59 days past due was basically on par with last year. Same with this bucket here. And also 90 to 119 days past due. But look at the big change for 120 days past due. So 1 year ago was 2.8% of all mortgages were 120 days or more past due, and now it's only 1.1%. And meanwhile, the foreclosure rate still remains near a historical low. Double-digit home price gains for more than the past year resulted in big equity gains in the first quarter of this year, which of course helped overall mortgage delinquencies and of course foreclosures near all-time record lows in April. CoreLogic also examined a very important metric to follow, and that's transition rates. This indicates the percent of mortgages moving from one stage of delinquency to the next. In other words, the percent of mortgages moving from current to 30 days past due, or 30 days past due to 60 days, or 60 days to 90 days past due. So looking at this, current to 30 days past due only increased slightly compared to 1 year ago. So the share of mortgages that transitioned from current to 30 days past due was only 0.7%, and 1 year ago it was 0.6%. But look at the change here. So 30 to 60 days actually decreased from 18.9% down to 17.2%. So in other words, the share of mortgages that transitioned from 30 days past due to 60 days past due for mortgages basically decreased from 18.9% to 17.2%. And the share of mortgages that transitioned from 60 to 90 days was basically flat compared to a year ago. All right, check this out because this is very important because a lot of people are saying we're going to be seeing a huge amount of foreclosures, but right now the data does not support that because overall the delinquency rate, which is overall defined by 30 days or more past due, including those in foreclosure. So as of April 2022, every single state logged a year-over-year decline in the overall delinquency rate. In other words, there was not a single state on a year-over-year basis where they had an increase in the overall delinquency rate. In fact, the states that had the biggest declines were actually Nevada, down 3.2 percentage points. That was followed by Hawaii, down 3 percentage points, and then New Jersey, down 2.7 percentage points. So all the states here in gray had a decrease in their delinquency rate by 0 to 2%. The states shaded here in blue were down 2 to 3 percentage points. And the states here, which was only one of them, is Nevada, down 3.2 percentage points. In stark contrast, here are the states that had the highest share of serious delinquencies. These are defined by 90 days or more past due on their mortgages. So Louisiana led the pack at 2.9%. That was followed by New York, Mississippi, Oklahoma, Hawaii, and these other 5 states here as well, all above 1.9%. I will have to say though, even though Louisiana is at 2.9%, still historically speaking, that's still very low. CoreLogic also reported on serious delinquencies based on different metro areas across the United States. So check this out because this is pretty insane. Again, a serious delinquency is defined by 90 days or more past due, including loans in foreclosure. So check this out because there was not a single metro area that had a serious delinquency rate increase. So every single metro area across the United States had a decrease in serious delinquencies. So in other words, there was 384 metro areas where the rate actually decreased. So every single metro area had a decrease in the rate here. And the areas here shaded in light gray here had a decrease in their serious delinquency rates from 0 to 1 percentage points. In stark contrast though, the states here in pink, or the areas here in pink, had a decrease in overall year to year in their serious delinquency rate by more than 2 percentage points. And CoreLogic also shares the largest metros across the United States here and how they fared regarding different rates here. So the highest rates were actually in New York and also in Jersey City at 4.1%. That was followed closely by Houston, Texas, and also Sugar Land, Texas as well at 4.0%. In stark contrast though, the areas with the lowest rates were actually in San Francisco, Oakland, and Hayward, California. That was followed closely by Denver, Colorado. What's also helping preventing future foreclosures here is due to credit availability decreasing. So this is the latest news from the MBA as of July 12th, and they're reporting that mortgage credit availability decreased in June. So what this basically means is that they have what's called a Mortgage Credit Availability Index, or their MCAI. So a decline in this index here indicates that lending standards are tightening. In other words, it becomes more difficult to get a loan. We want to see that if we want to have a healthy housing market. In stark contrast, when the index actually increases, this means loosening of credit, which is obviously a big no-no, and that's what we saw in 2008, for example. So here's the trend of their index ever since 2011. Again, when their index is high, like we saw basically in 2016 through 2019, that's indicative of loosening credit standards. But ever since this pandemic hit in 2020, credit standards actually tightened, so it became more and more difficult to get a loan. So right now, the current index of 119.6 is on par with what we saw in the last half of 2014. And have a look at this because this is pretty mind-blowing. So here's their index ever since June of 2004. So basically in 2005 all the way until 2007, their index was basically off the charts, which of course means they have very loose lending standards back in the bubble years. As you can see here, it started to increase around 2013 all the way until we hit the pandemic. The pandemic hit, it fell off greatly, and the index has basically been flat ever since then. So what this basically means is that obviously lending standards back in 2005 to 2007 were very, very loose. People were getting mortgages that they couldn't afford, and that's one reason why we saw this foreclosure crisis back in 2008. But fast forward to now, lending standards are very tight, especially compared to the Great Recession. And it says here, although there was a reduction in programs available for people who want to refinance, who have a low credit score or a high loan to value here, the decline in this index here, in other words, a tightening of lending standards, the decline in this index was offset by increased offerings for conventional ARM or adjustable rate mortgages and high balance loans. With high rates and elevated home prices, more prospective buyers are applying for ARMs, but activity remains below historical averages. So the latest trends we have from the Mortgage Bankers Association for the week ending July 8th is that out of all the people submitting loan applications for home purchases, only 9.6% of those are for ARMs. Now, granted, this is approximately 3 times the share back in January of this year, but still below the year-to-date highs of around 12%. So comment below your biggest takeaways from today's video. Also, if you got any value of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.